Welcome to TradeTheMBI.com. This is John. This report is for the 23rd. Beautiful day here in Florence, Italy, continuing our lockdown. No movement. The market is continuing its, progression, of course. Is it really that much? I mean, it really does look remarkably like the 29 chart where you had the big drop, nice bounce back rally that then ends up rolling over. We're in a weak position here with now orange caught in between the middle of magenta, cyan here, and red. However, it is dropping along with short-term buyers popping. That should be enough to help support things. However, shakeout is in negative territory. If it rebounds, that would be the positive sign. It seems like every time we're hitting the key supports now, this is where the buy activity pops in. But it's becoming harder and harder to justify as we start to see the really bleak situation that most companies are in. In fact, I could put up an article real quick here because we were talking about mortgages and I talked about credit squeeze. So let's take a look. This happens to be a Zero Hedge article. Mortgage lenders like Wells Fargo, all of them, it may sound unusual, jumbo loans and that, but those are just anything that are outside the FHA normal conforming loan value, which in California I think applied to almost every single loan that was ever done. I mean, when you're getting $1 million mortgage or whatever, it's just way outside the line. I remember you go to these various things and it's just investors who put into a pool to handle it, and so these remain on their books. So they're not going to do them, and the reason being is they want to go with where the government is, which is they're going to take it over, and it'll be under the Treasury. And you're reaching that point where we talked about this a while back after the recovery from before, that the next setup was this conversion where the Fed was going to own most mortgages. And it may end up turning out to be that with this dry up of liquidity, they may end up having to become lenders. It's just getting to be insane because, JPM recognized this back in December. Interesting timing. They did it right at the exact time that the virus was hitting in China when they started drying up the repo market. From a liquidity standpoint, and so that all built into the final coup de grace that we could see coming. And this is an interesting one because it's like there's so many people who don't see what's coming on the horizon. They couldn't see the virus buildup, even though all the evidence was pointing to it. I remember talking to so many people even here, and I'm like, hey, do you have contingency plans to get back? And this was in late February, and they looked at me with this puzzled look, like, what planet are you on? There is nothing wrong. I listened to the news and it said that everything was under control, and this is what you get because if you listen to the media now, you've got to stay in. Nothing can change from the narrative. You hear that sound? That's a regular occurrence. The sirens, it's always an unfortunate thing. That doesn't happen as bad as it was a few weeks back, so there's been a huge improvement here. And it's interesting because, despite what you hear in America about the hydroxychloroquine, they're using that more and more here, and it's making a big difference. In fact, they're going to start handing them out in packets with the azithromycin. I don't know if it was going to include the zinc as well, which is interesting because you're getting these huge press reports in America about the quote-unquote ineffectiveness, and there's a lot of anti-Trump sentiment because he's the one who recommended it, but the French doctor came out and was like, I don't even know what they were doing with that study. It was complete junk, but it'll be interesting because this is going to become this war, this culture war of going back to work versus, hunkering down, the fear or, courage kind of construct. And so we have to look at it in the dynamic of, what can happen market-wise. Well, we know the Fed has unlimited purse strings, and they're applying it because you're going to see some horrible numbers starting to come out from some of these companies who are in massive amount of debt from all the buybacks, and they don't have the ability to sustain themselves. And with an irregular opening of markets, Even Trump was blasting the idea of, in Georgia, them opening up, hair salons and certain other things. He wanted them to wait a little bit longer. And I don't know that there's a little bit longer. You cannot have an uneven open. It won't work. Here, from an ECB standpoint, Italy is going to be downgraded most likely by the end of the week. The ECB then has said, okay, we're going to accept any junk-rated assets that you have from September of last year. So whatever their value was back then. Which, how divorced from reality can you get? And that's what's going to become more and more the likelihood. You're going to have this divorce from this concept of value and what it really means. And so, people might be saying, well, why are you going on about this? Well, you have to prepare your mindset for this, because it's not going to make sense when you see an absolute collapse around you and the market's still holding or going higher. Because there's a very good likelihood. And so you're going to have to be able to divorce yourself from what we see reading-wise versus what everything in your gut tells you is actually happening in the real world. Because the markets have never been real world, and if you didn't know that before, welcome to understanding of that. So the euro, it's going to be hard pressed because they've got nothing to build it up or support it. And as these, who are they going to sell the worthless bonds to? The ECB is going to have to buy them, which means basically, again, it's sort of like the Fed, is buying up all the treasuries that are being issued by the government. It's the same concept. You're making up the money, and then you're saying, oh yeah, I'm the one taking on the debt. It's not really owed to anyone, and you're just printing the digital money. And that's always going to be from a devalued standpoint. And eventually, it's going to create hyperinflation. It's not created yet because you got a massive glut of oil. There's nowhere to stick it. This becomes a real interesting issue here in another week or two, because Saudi Arabia's got, 50 million barrels on the sea right now that should be here in May. The only place left with any capacity, I think, is the California West Coast area, and they're going to be done in another week or two because they were already at 60%. So where's oil going to go? Negative pricing could be a while. I don't know whether or not the U.S. Strategic Reserve can handle, and I don't know logistically if they can even move enough oil to make a difference in the near term. But it's catastrophic. And what do you do with those companies? You're going to bail every one of them out. Some of them were managed properly, some of them weren't managed properly. This is the same thing in business. You've got the difference between an Apple with hundreds of billions in cash versus an IBM that has nothing because they used all their money for share buybacks and stuff. So what's the proper balance? Is it just better to let them restructure or go under? I mean, that's been too big to fail is the religion of the current era. So, but when it comes to having to do that with every company, that's going to be problematic. And so, and the more people get scared, the large group is still going to flock to gold as a store of value. From an intraday standpoint, we started up higher, and then you'll notice we ended up with a lot of good short signals. They just didn't produce much, and that's just because there was buying at every single end. We're talking a lot of these Sigma events taking place all at once, which means there's irregular activity taking place in the market. Duh, right? Didn't take a rocket science to figure that one out, but I mean, just going with every one of the upticks with it worked out beautifully. So despite the short signals, the upside pushes each time were pretty clean. I didn't produce a lot because there really wasn't a whole lot of range movement set up for right now. That should start to change here as we start getting it unfolding. There was a relief factor on passing the extra $400 billion in business relief. But I think that, as Mitch McConnell said, he's sort of done with the spending. There's a point, it's sort of like when you go out and you binge spend and you're just like, no, I've had enough, I'm done. And I think that some in Congress have kind of reached that point where it's like, okay, now it's getting stupid, as if it wasn't already before. But here we are, and still maintaining it. I mean, we're right now green on it. I would expect a narrow range between the, if we go back to our daily chart and look at the ranges. This 27.35 and an upside of the 28.76 with, using that 50% movement back and forth. I think it makes it kind of an easy call. I'm not afraid to be both long and short. I'm a little bit more biased to the upside simply because of if you monitor where the support levels are, bounce off them every time, and that's just the ability of them to buy up whatever supply there is. So it doesn't matter whether or not it's fundamentally accurate or not. When you have artificial intervention, you just have to go with what is, and that I think is probably the best approach. Just go with what is. As always, we're going to have fun putting up charts on the Skype chat and going through it all. As always, though, trade well. We'll talk to you later.